Hello and welcome to Biniba Academy. Today, let's discuss factors influencing the price of an option. Now, in the previous two videos, we observed how the holder, one who was long in the option, and the writer, one who was short in the option, made profits. The price of the option plays a key role in determining these profits for both parties. Hence, let's dive into the factors that influence the price of the option. The option price, determining it is one of the most challenging tasks in the quantitative finance field. It is initially set by the writer and then begins to fluctuate based on the demand for the option. Payoffs, the greater they are, the greater the demand for the option and hence greater the price. Remember, the greater the payoffs for the holder, that means the greater the loss for the writer. Hence, the option price acts as compensation for the writer's obligation to the holder when it is exercised. Pricing the option must take the payoffs under consideration. So let's look at some important jargon before we dive into the factors that influence the price of the option. An option is considered in the money when it provides a payoff greater than zero. It is considered to be at the money when the payoffs are equal to zero. That means the strike price will be equal to the stock price. It is considered to be out of the money when the payoffs are less than zero. Now, the higher the payoffs, the higher the price. Hence, the price of an in-the-money option will be greater than that of an at-the-money option, which should be greater than that of an out-of-the-money option. So now let's look at factors influencing option prices. We already saw how payoffs play a key role in determining the price of the option. So we see that the payoffs are also directly influenced by the stock price and the strike price. This was all discussed carefully in the previous two videos. So just briefly, we noticed that higher the payoffs for the holder, there'll be a greater demand for the option, and higher the payoffs, there'll be greater the loss for the writer. Therefore, the price will be higher, which is how the price of in-the-money options will be greater than that of at-the-money options, which are greater than the price of out-of-the-money options. So let's look at how the stock prices and strike prices influence the price of an option. We have the payoffs of a call option and a put option when the strike price is equal to 100 displayed. Now, as you can see, the greater the stock price, the greater the payoffs for a call option, and the greater the stock price, the lower the payoffs for a put option. Therefore, the price would be greater for call options when the stock price is high, while it'd be lower for put options when the stock price is lower. Now let's look at strike prices. What if the strike price is increased from 100 to 105? Then the payoffs of a call option will be lower and the payoffs of a put option would be higher. Now, what if we decrease the strike price instead of 105, we go to 95? So when the strike price falls, the payoffs of the call option are greater and the payoffs of a put option are lower. So we can see that for a higher strike price, the price of the call option will reduce, and for a higher strike price, the price of a put option will increase. Now, what are other factors that may influence the price of the option? The first one is time to maturity. Now remember, all options have an expiry date, and the time to maturity is essentially the days left to maturity from the present day. So if the time to maturity increases, the option is potentially impacted by more movements in the underlying price. As we can see, the duration of the contract has increased, so there's more chances of the price moving or the movements in the price being greater during the increased duration of the contract. So as these movements increase, the probability of the option going in the money or out of the money gets greater. However, it's the in the money aspect of it that's more important, as writers face greater risks when the option is in the money compared to the rewards of it being out of the money. Therefore, for an option, for the instance when the probability of an option being in the money has increased, the demand for the option from the holder's point of view will increase. And since the payoffs of the option have gone higher, the loss faced by the writer would increase, and hence they would demand for more compensation. Therefore, the price of the option would increase when the time to maturity of the contract has increased. Now, let's look at the volatility of the underlying price. The volatility is essentially the degree of variability in the underlying asset price over time. If the volatility increases, the option is impacted by more movements in the underlying price, similar to the instance we discussed about the time to maturity. Therefore, the probability of the option being in the money increases, and hence the price of the option will be greater. So we saw how an increase in time to maturity and volatility increase the price of the option. Next, let's look at the type of option. For simplicity, we only consider two types, the most vanilla type of options, which are the European option, which allows exercise only at maturity, and the American option, which allows for early exercise anytime before maturity or at maturity. Now, due to the benefit of being able to exercise the option early, the price of the American option is always greater than that of the European option. So we can see how certain details or aspects of an option contract impact the price. Next, let's look at the risk-free rate. Now, the greater the risk-free rate, the greater the expected increase in the future underlying price. Hence, given that the expected price in the future of the underlying asset would be higher, the price of the call option would be greater and the price of the put option would be lower. Now, risk-free rates also have another impact where the present value of the future option cash flows will be reduced as the risk-free rate increases. Therefore, the price of both call and put options would be reduced. However, on an overall basis, an increase in risk-free rates would increase the price of the call option and reduce the price of the put option. Next, we have dividend yields. That's only applicable to underlying assets that pay a dividend. So if there's an increase in the dividend yield, the underlying asset, the price of the underlying asset after adjustment will be reduced, and hence the price of the call options would reduce and the price of the put option would increase. Now, when we're considering the impact of the risk-free rate and dividend yields, it is best to consider the cost of carry, which is the cost of holding the underlying asset. And in this case, that's a risk-free rate minus the dividend yield. So it's best that we consider this cost of carry to assess the overall impact of change in risk-free rates and change in dividend yields. To summarize, we learned that the greater the option payoffs, the holder will have a greater demand for the option and the writer will face a greater loss and hence require more compensation to meet the obligation to the holder. Therefore, the price of the option would be greater. We also saw that factors such as the stock price, the strike price, the risk-free rate, dividend yields, volatility, and time to maturity influence the prices and payoffs of the option. Now, is there a way to take these factors under consideration and determine the price of the option? Yes, there is. The Black-Scholes model from 1973 considers all the discussed factors while pricing options. Stay tuned to the next video to see how the Black-Scholes model works. Thank you.